Ladies and gentlemen, good day and welcome to the Nuvoco Vistas Corporation Limited Q4 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. I now hand the conference over to Mr. Vishnu Sharma, Head of Investor Relations from Nuvoco. Thank you, and over to you.
Good evening, everyone, and a warm welcome to Nuvoco's FY26 earnings call. We appreciate you taking the time to listen to us. Let me begin by sharing a few key highlights as we reflect on our performance in fiscal year 2026. We ended the year on a high note and delivered the strongest annual performance for Nuvoco, which is the highest volume of 20.4 million tons and EBITDA of 1,881 crores in the history of the company. We expanded our industry-leading premiumization base by 300 basis points year-on-year to 43% in FY26, and thus establishing a stronger base going forward. The fourth quarter was also a landmark quarter as we, for the first time, reached a 6 million ton volumes with a historic high quarterly EBITDA of 580 crores. We witnessed improvement in overall demand during fourth quarter as the capex by both state and central government gained momentum, which is up by approximately 12% in Q4 till February, supporting infrastructure activities and cement demand. Overall, in our view, we performed well in FY26 despite the challenging market conditions and headwinds witnessed during Q2 and Q3. On the growth agenda, we are pleased to share that the Gujarat cement project is progressing well and remains on schedule. The clinker unit and grinding units are planned to be commissioned in phases between Q3 FY27 and Q1 FY28. Let me give you a quick on-the-ground update on project execution at both our Kutch and Surat facilities. In Surat grinding unit, key equipment and spare deliveries are completed. The 66 kV grid connection has been established. Equipment upgradation and electrical installations are nearing completion and trials commenced. In Kutch clinker unit, equipment upgradation and electrical panel testing are underway. Cyclone inspection for refractory assessment is in progress and deliveries are on track. In Kutch grinding unit, civil works are on track with work on silo, VRM foundation, packing plant and hopper building progressing as scheduled. Installation work of VRM has also started. For Kutch railway siding, engineering scale plan and detailed project report approvals from Indian Railways is at an advanced stage and site execution has also commenced. We are also establishing a bulk cement terminal at Viramgam, Sachana, Gujarat with a dedicated railway siding and a handling capacity of approximately 1.5 million tons per annum. The terminal will enable efficient unloading and storage as well as dispatch of loose bag cement. It will serve as a strategic distribution hub to expand our reach across the Gujarat market with commissioning targeted for FY28. Alongside this project, our East expansion program of adding 4 million tons per annum of grinding capacity in phases through FY28 is also progressing well. Looking ahead, we remain confident that the structural demand story for cement is intact. On infra, central government capex for FY27 is planned to grow by 20% and state government capex to grow by 15%, implying a meaningful step up in construction activity. On housing, the PMI Gramin allocation is up 73%, and in the East specifically, state governments have planned housing schemes worth approximately 29,000 crores for FY27, which is directly positive for Nuvoco, given our leadership in the geography. Moreover, the Asian Development Bank recently revised India's FY27 GDP growth estimate upward by 40 basis points to 6.9%, with a further acceleration to 7.3% projected for FY28. This is a constructive signal for cement demand going forward. While the structural demand outlook remains positive, we are mindful of near-term headwinds stemming from current geopolitical uncertainty, rising fuel prices, currency volatility, escalation in raw material costs, particularly for packing materials, could exert pressure on margins in at least 1 to 2 quarters going forward. We are closely monitoring the situation on the ground. We have already initiated proactive measures of price hikes, prudent procurement practices, accelerated cost optimization initiatives, and strengthening supply chain efficiency to mitigate the impact and protect our margin profile to the extent possible. With that, I conclude my opening remarks. I'm here with Mr. Jay Kumar Krishnaswamy, Managing Director of Nuvoco Vistas, and Mr. Manish Agarwal, CFO, Chief Financial Officer. We're happy to answer any questions you may have. Thank you very much. Over to you, Sri.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Siddharth Mehrotra from Kotak Securities. Please go ahead.
Thank you, sir, for the opportunity. Sir, one quick question on our CapEx. Now, it seems that when we first announced the expansion in East...
You have to speak a little bit louder on the mic, or if it's on the handset, so we can't hear.
Is it better now,
Can you
sir?
use your handset mode, please, Siddharth?
Yeah, I'm using my handset mode. Is it better?
Yeah, go ahead.
Yeah, so I just wanted to check, sir, at the time when we started our East debottlenecking plans, I think it was mentioned that we plan to have them possibly by the end of FY 2027, with certain capacities coming online even by the end of FY 2026. Now, it seems that we've slightly delayed those plans. So, I mean, if you could help me sort of understand what sort of timelines we are looking at with respect to the expansions in the East, that would be really helpful.
Okay, thank you. So, as mentioned in a couple of calls ago, we had clearly mentioned that we are doing a debottlenecking of close to about 4 million ton capacity expansion in East, with million ton coming from all the 4 plants of Jojobera, Orissa cement plant, Panagarh cement plant, and Arasmeta cement plant. The timelines we had mentioned was in end of FY26 or Q1 FY27, we will commission Jojobera, Panagarh, and then subsequently Jajpur, and last will be Arasmeta. So we have more or less done the debottlenecking in Jojobera as well as Panagarh. We're just waiting for the CTO. So NIPL has been completed, which is no increase in pollution load with there's a clause which says that much amount of expansion you can do. That is already done. And we're just waiting for the final approval to happen. So in terms of hardware modification, it's all done in this 2 plants. Jajpur should happen in the next 2 to 3 months, and Arasmeta will happen by the end of this year. So certainly by the next few weeks or a month or so, we should be able to, once the CTO comes, we should be able to make an announcement on completion of this expansion.
Understood. So everything should be online by the end of FY 2027. Is that correct? The correct way to look at it?
Definitely. It should solve more or less. We're just waiting for the CTO to happen.
Understood. Secondly, sir, quickly on the fuel mix, given the sort of volatility in the energy markets due to the ongoing conflict, could you just tell me what is our current kcal cost and what sort of change do we sort of expect once we sort of transition to the newer coke procurement or coal procurement, as the case may be, and what sort of price increases we are looking at on the power and fuel cost side?
Yeah, I guess number of things which you asked. Basically, the impact has happened on 3 levels. One is obviously petcoke. Second is impact of international coal prices in the domestic coal prices, and the third one is the impact of rupee depreciation because all the pet coke is imported. In Q4, our blended fuel cost for the company was 1.44 rupees per million cal, and that was more or less same as the previous quarter. We were already done at 1.43 types, so we are more or less little bit more than that, but at 1.44, not too much of a difference. But then as we enter Q1, pet coke, which was at 1.84 rupees per million cal, is becoming 2.01 rupees per million cal. And we also have adequate stocks for 6 to 8 weeks, and some of the orders which we have booked on pet coke or on high seas at the rates which were prevailing during middle of March or end of March. So we are foreseeing a number of in Q1 anywhere between 1.51 to 1.55. So we will also keep on altering the mix to ensure that we get Chacha coal or Eastern Coalries coal or increase or decrease of AFR. So that's how we should have a range of close to about 1.51 to 1.55 should be the number I foresee for Q1. But all the shipments which are currently booking, which should come around July, August, which will have the impact for Q2, there I guess there will be a further increase in blended cost for the company. And there I think it's too early for me to give an outlook what will be the cost as we see, because we are already booking now. But suffice to say that this 1.51 to 1.55 which we are forecasting for Q1 will further increase in Q2. So that's the outlook I can give. Obviously, all this will have an impact on the energy cost for the company. Few things which we have taken during the month of March and certainly in the month of April. From the exit prices of March into the prices in April, we have taken price increases in both the trade and non-trade channel in all our markets. In eastern markets, we have taken a price increase of rupees 10 in the trade channel in across the states of Bihar, Jharkhand, Bengal, Chhattisgarh and Odisha. And on the non-trade side, we have taken close to about 20 rupees per ton, rupees per bag price increase in all our states. So east has been 10 per bag in trade and 20 per bag in non-trade is the price increase we have taken. And this has not happened on 1st of April, it has happened around 6th, 7th, and then non-trade typically price increase we take it on the 10th once we finish the orders for the previous month. And hence I think we would get a number which will be anywhere between 7 to 10 rupees for the full month, and also non-trade could be 12 to 18 rupees for the full month. That's on the east side. On the north side, similar price increases we have taken in all our key markets of Rajasthan, Haryana, Gujarat, Western MP and Punjab and Western UP. There we have taken a 10 rupee price increase in trade, and non-trade has been different in different places, close to 15 rupees price hike in Gujarat and about 10 rupees price hike in Rajasthan, Haryana and Western UP. Here again, if you see the blended price increase in trade should be anywhere between 8 to 10 rupees and non-trade will be 10 to 12 rupees. So technically, across the markets where we operate, we can say that we want to inform that price increase we have taken is anywhere between 8 to 12 rupees in trade and 10 to 15 rupees on non-trade.
Thank you, sir, for the detailed answers. Good luck. Thank you.
Thank you. Ladies and gentlemen, in order to ensure management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We'll take our next question from the line of Pinakin from HSBC. Please go ahead. Pinakin, your line is unmuted. Please go ahead with your question. Since there is no response, we'll move on to the next question. Next question is from the line of Naveen Rameshwar Sahadev from ICICI Securities. Please go ahead.
Yeah, good evening, and thank you for the opportunity. 2 questions. One was, if you could talk more about the cost impact probably which we faced in March month in particular, because ever since this Middle East crisis broke out, we were hearing a lot about issues related to the packaging cost, especially the bags not being available. And so did we face any impact in the month of March, or we had inventory, so now the impact of that front would come in Q1? And then related to this, related to the same cost angle, my second question was, what was the petcoke mix in this particular quarter, and how flexible is it to, like, I'm assuming you would be looking to lower it. So how flexible, how much could it go down further and offset by domestic coal so as to mitigate the impact? That is my first question.
Okay. Fine. The previous question which was asked, I responded only for the petcoke and energy cost movement from Q4 to Q1 in terms of rupees per million cal. Of course, in the month of March, we had a relatively sizable impact which came from the packaging bags and granules. The granule prices in the market, which was at 99 rupees per ton per kilo, which was in February, over multiple phases have shot up to 155 rupees per kilo, which resulted in increase in cost of packing bag, and that did impact the March costing of bags. We had an overall impact of close to about rupees 20 per ton at a consolidated level for the company. But that is for, since we also carried sufficient, bags inventory, as well as we are on a granule conversion model. So we also had granules of different values with us, and hence the impact which happened in the month of March was close to about 20 rupees per ton. But the number is going to further increase in the month of April. Certainly already we are looking at a close to about 100 rupees per ton increase due to packing bag cost increase and granule cost increase and conversion cost increase which has happened. So that's something which currently loaded on the cost line. Certainly I have no view on whether this 100 will remain 100 or it will go up. That's all subject to the granule cost, which is kind of gone up from 99 to 120 to 140 to 150 to 155 in multiple steps. Currently it's holding out at this kind of number, but if the conflict were to continue for longer and then we are going to have issues with incoming crude, I think this number will also have negative side because the government of India has already asked the granule manufacturers to divert crude for making LPG and other stuff, and then there is a general shortage of granules in the market. So April we are looking at 100 rupees per ton increase in packing bag cost. And May and June could be, I can't make a guess, it could be at this level or a little bit go higher also in the coming months. Other than that, the cost inflation did not happen in March, but will happen going forward is the cost of mineral gypsum. Mineral gypsum is also used in manufacture of cement along with FGD as well as chemical gypsum. And there we can see close to about 20 rupees per ton increase because of mineral gypsum import cost. Most of the mineral gypsum comes from Oman, and there again the supply lines are cut. So the second question is you asked what is the company doing to mitigate this cost inflations. As far as bag is concerned, it's going to be difficult because it's not possible to mitigate because that's the only source is the granule manufacturer in the country like IOCL or Reliance. So that's where the granules come, and there I think there is a challenge. So it can't be mitigated. It can be only offset by price increase. As far as petcoke increase, obviously we have a formula. We have a fuel mix in east and north is different. Nuvoco is also close to about 70+% sales which happens through east market, and there our key factories of Arasmeta, Sonadi and Risda. One of the things which we have done in our three plants is we have reducing continuously the use of petcoke. We are changing the fuel mix in the calciner and we are changing the fuel mix in the main kiln. As we speak, people are all working on this effort to reduce the petcoke consumption in Arasmeta and Sonadi to less than 20% from the current 25% and also from Risda from the current 35% to less than 30%. So that's going to have a good impact. And with this reduction, we're also looking at other coal sourcing from eastern collieries and Charcha coal and various other coal initiatives. So the blended cost is being controlled by reducing the petcoke consumption as well as try and get local coal which will offset the overall coal. Local coal prices have also gone up, but overall I guess the initiatives are being taken to reduce the consumption of petcoke by at least 300 to 500 basis points from Q4 actual consumption. That's on the eastern side. On the northern side again, we have entered into some unique coal contracts with Central India as well as from Varanasi depot to get also some domestic coal which we have not used in the past to be used in the kiln in our Chittor factory. There again our target of petcoke consumption which was in the 55 and 60% has been brought to 50 and we are further reducing to 45% by use of domestic coal. In Nimbol, we are still trying to work out some new alternatives to see whether lignite can be blended on the kiln and reduce further the petcoke consumption. So technically speaking, in northern plants, our petcoke consumption from 50 we are trying to come to 45, which with the efforts of our manufacturing team will be able to certainly reduce by 200 to 300 basis points. Number two, increase of AFR in these two plants. We have full-fledged investments done in Chittor and Nimbol for AFR processing, which will have the refused material or carbon black or rest of all the stuff. So North is going to be unique domestic coal into these plants, number one agenda. Number two agenda is to try and see whether we can process lignite. Number three agenda is to increase our AFR quantity so that our cost in North is brought down to less than 50% of petcoke consumption. East is going to be overall reduction in petcoke by about 300 to 400 basis points, supplemented by increase in use of charcha coal waste, or get it from eastern collieries. So that's the broad work the teams are doing. And on gypsum usage, a big initiative we are doing is to find out how can we supplement mineral gypsum from replace mineral gypsum with FGD gypsum. I think our procurement teams are working with nearby power plants in all the plants to try and increase the use of FGD gypsum in all the plants, which will reduce the cost of gypsum usage. So gypsum will be controlled. Fuel costs we are working on. Bags, I don't think at this point of time there's a clear-cut way forward, so we'll have to live with the price increase. And that's broadly the agenda for the company to mitigate the cost challenges.
Yeah. So thank you for the detailed reply. My second question then was on the pricing and the competitive intensity. So you did mention in your, I think, previous questions that the range of price hikes that have happened both in North and as well as the East region. I think similar sort of a commentary we had, I think, witnessed or heard in the previous Concall also at the time of January that there is some price hikes. Despite peak season demand, I think the price hikes that have happened in March, a quarter as a whole, have been a little underwhelming, just about 2% or so. So I just wanted to get your views about the confidence of this price hikes now sustaining, because I think April, May onwards, you also start seeing the seasonally weak monsoons coming through and then the impact of overall volumes and the regular weak season thing. So do you think these price hikes in April are more sustainable, or you think it can still be some, like it could still face challenges with the onset of monsoons? Thank you.
Demand, supply and pricing typically will go through the classic demand supply model. But right now we are not on certainly demand supply framework at all. These are all unique times and if you see almost every industry and every sector in India has taken price increase. Paint industry, adhesive industry, automobile industry, FMCG industry, almost every industry whose raw material is crude linked have taken price increase. So there is no escaping the fact that we will not absorb this. We will absorb this inflation and reduce the profitability of the company. So unlike in a normal scenario where demand peaks and or demand drops and then supply is there will always be pressure on pricing. But these are all abnormal times, and I guess every player in the industry in our sector or outside the sector is facing the impact of crude. And I am fairly confident that the price hikes which we have taken will stay put in the near term, and hopefully further cost inflation doesn't happen, then we could I am confident we can stabilize with the current prices. But I certainly feel that if further cost inflation happens, I guess we'll have to find a way to pass on the cost inflation down. So that's the view I have, and that's how our thought process is.
Yeah. So just to conclude, we will see more price hikes if there is a further cost inflation. Otherwise, so far the price hikes are good enough. Is that the way to look at it?
If you really put the mathematics of it, so I cannot get into details of the total cost increase and the total price increase. Obviously, 100% one cannot defray on step one. But by and large, the efforts which we have taken to take the prices up in trade still doesn't meet all the cost inflation. But there again, I think efficiency programs are being run in the factory to offset the impact of the cost inflation, but certainly supported by price increase, geo mix, product portfolio, and trade non-trade ratios, all the other agenda which we are working. So it's not like 1:1 ratio, cost increase by 100, price increase by 100. That's not the way one works. So I guess there is certainly acknowledgement there's a cost increase. So we have done the price increase to kind of mitigate the issues coming out of the cost inflation. But in parallel, as a company, as a manufacturing organization, we are embarked into number of initiatives on energy side, raw material side, efficiency side, product mix side, rest of all the stuff to ensure that we are able to compensate for the cost increase with some internal efficiencies as well.
Thank you, sir.
Thank you. We request participants to restrict themselves to 2 questions at a time, please. You may join back the queue for follow-up questions. Next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Sir, just Jaikumar, just a follow-up on the packaging part. You mentioned that there is some conversion where you source granules on your own and then give to packing companies for conversion. Just a couple of questions around packaging specifically. So, what is the inventory that you have for packaging? Just trying to understand, because there are too many moving forces right now in terms of seasonality for packaging that we're hearing. So what is the inventory level you're carrying? Just trying to assess the risk of availability of packaging bags. When you source granules on your own, is it something higher versus the industry, and are you facing any challenges like everybody else in sourcing the granules? And third, on this packaging specifically, that historically when we saw fuel cost inflation in 22, there was a pivot to blending because you reduced the share of clinker in the overall mix for the industry. Now you have higher fuel cost inflation, but you also have higher packing costs, which would naturally mean companies try more non-trade cement. So where are you pivoting to in terms of trade, non-trade mix this year? So all these are tied to packaging. Then I have another question. I'll come back for balance sheet, cash flows and all.
Okay. In terms of the bags, typically we carry about 15 to 20 days of bag inventory. That's the stuff. And I guess it is so volatile that the bags currently which I have are at a price which was already at 155 rupees per kg granule. And I guess any further increase in price, again, the bag cost is going to increase. So when I mentioned the impact of granule price increase, which will come for full month, April will be close to about 100 rupees per ton. So that's like kind of done deal for the month of April. Any further increase in granules will anyway go to month of May. There can be next cost impact will further go up in the month of May. As regards the granules and conversion models, I don't know about other companies, so we have adopted this approach for more than a year now, where we source granules from granule manufacturers and then put it on a conversion contract with our bag manufacturers and run. But currently, since the overall granule availability itself is kind of reduced, so we still get granules from our granule manufacturers, but also use the granules which the packing suppliers already have. So right now it's a blend of granule supply model as well as outright bag purchase model. So that's how we are navigating. We'll continue to navigate the same way till such time the entire situation gets back to normal. That's the scene on packaging. But in terms of impact of packaging into trade segment and non-trade segment, or moving from bag cement to loose cement, typically we are a company which operates at a pretty high trade to non-trade ratio. And also our CK ratio in East is already over 2.1 is the CK ratio which we operate in East. And in North and the CK ratio is a little bit lower because we have more OPC content in North. So overall the company's CK ratio is 1.72. It's pretty high if per industry standards. I don't see the CK ratio going much higher than this kind of number in the short run. So we don't have any programs to move from CK ratio at current level to any other number to compensate for the various cost increases. As regards the movement of non-trade from bag cement to loose cement, certain markets do operate at a loose cement model, which is typically the Gujarat market. So we would, and also some parts of Chhattisgarh, we still would send through loose cement. And if you ask the question, is there a huge thrust to move from bag into loose? Not really. One thing which we are really focused on right now is to kind of move away from OPC to blended cement more in East in the short run, so that our CK ratio can further increase and energy cost per ton of cement can come down. So that's the specific agenda I need. Not again OPC markets we are trying to go a little bit slow, but in Gujarat we won't be able to do because the market constructed itself in that way. But rest of the markets like Rajasthan or Haryana, our focus is to kind of move away from OPC to get blended cement. But that's independent of this energy agenda, because in the past calls they had mentioned that our North capacity is more or less reaching capacity utilization. So if we have to kind of unlock cement in North in the short term till Vadraj comes into being, we will continuously move away from OPC to a blended cement to increase that much more cement available for sale in the market. So that's a separate agenda, not linked to the energy crisis.
Thank you so much for this elaborate answer. Just to follow up on this. So, cost increase on the packing side is well understood. Just on the availability of bag, also either granule or bag, are you foreseeing any challenges where there is shortage and that restricts the ability for cement manufacturers to manufacture? And in that context, we heard from some channel checks that there were specific pockets where Nuvoco actually faced some challenges for very short period in the quarter, and that was overcome through various means. Maybe if you can talk about, were there any challenges in the quarter in terms of availability, and did that disrupt production at all? And how are you foreseeing the availability, and what actions can you take in this? Because generally there is a fear that there may be some disruption if you have lower availability of bags.
I think it's an industry phenomena. So everybody in the industry got impacted due to bag non-availability in the month of March, and it continues in April as well. So if you look at the East market, any market for that matter, a lot of bag manufacturing capacity came into force 3 years ago, and hence there has been a general capacity utilization, reduction in capacity utilization around COVID time, and beyond that, I think lots of capacities came into being. But typically April, May is the time when fertilizer movement also happens, and also with this Bangladesh issue of jute bags not coming to India, there was a general scarcity of bags which started happening from February onwards. So one was of the view that this entire fertilizer movement, as well as Bangladesh, nothing can happen because that is right now there is no jute availability there. But however, starting February itself, this issue of overall bag availability and heating up of bag conversion cost happened Jan and February, March. This war is a new phenomena which happened, additional phenomena which happened in the month of March. So we were of the view that come May, once this fertilizer movement and all happens, the capacity utilization of bag manufacturing will come back to normal and this should not be a problem. But with this issue of granule itself not available, then I think that added a new layer of serious challenge, not even new layer, It's a serious challenge, availability issue, price is a problem. I certainly can talk for Nuvoco, but I think because bag manufacturers are all common for all the cement manufacturers, I guess there is a widespread challenge for timely bag availability in certain markets all over India, more so in East, where capacity utilization of bag manufacturers are running to the extent of 90+%. So we did face in the month of March bags, and the number of 6 million, we could have done a little bit more in the month of March. We had two major disruptions which happened in the March. One was rake availability was a serious problem in the month of March because the government decided to divert all rakes for movement of coal to power plants. So typically we would get 4.5 rakes per day, and that came down to 4 rakes per day. So there was overall clinker movement challenge as well as bag availability challenge. In spite of that, we hit a historical high of 6 million tons in the quarter. We could have done more because we could have served the market. Demand was pretty good for us. But I guess that's what we have to live with. So we have to sail through the coming few months with this bag shortage. And also that if somebody had asked the next question, I had to share the issue of rake availability in the month of March. And as we sit right now, we are having serious problems of rake availability as well, and we have resorted to moving material by road to some of our grinding units because rake is not available sufficiently. All rakes are diverted to power plants. So I think this should reduce once the monsoon sets, but that's still a month and a half, 2 months away. So we face problems in bags. We will continue to face problems. I guess it's a tightrope walking. It's an everyday journey where we kind of find a way to source bags, incentivize for short-term incentives for the bag manufacturers to make. So all net with all the incentives, annual cost increase, it came to about 100 rupees in the month of March. It is continuing at the similar levels in April.
Mr. Jaikumar, I'll just ask one quick follow-up on the rake availability.
Satyadeep, I request you to join back the queue, please, as we have other participants. Thank you. We'll take our next question from the line of Shravan Shah from Dolat Capital. Please go ahead. Shravan?
Hi, sir. Yeah. Hi,
Yes,
sir.
please
Can
go
you
ahead.
hear me? Yeah.
Yes, please go ahead.
Yeah. Sir, you mentioned about in terms of reducing the petcoke share both in East and North, so roughly around 3 to 5 odd %. But currently in Q4, what was the petcoke percentage and the AFR percentage in the fuel mix at the company level?
Company level, our Q4 number, all blended fuel was 1.44 rupees per million cal. Out of which coal was 1.2.
Yeah,
I'm answering your question.
Yeah, sir, go ahead.
Fuel cost for the company was 1.44. Coal came at 1.27. Petcoke came at 1.84, and AFR was at 0.9. That was the number which we had for last year.
And in terms of the fuel mix percentage share, petcoke share and AFR share in Q4 was how much? And because we were looking at even AFR also to increase to 13 to 15%.
Okay. Our coal percentage as a company was 53% with linkage 31 and non-linkage 21, which is domestic open market coal. And then petcoke in Q4 was close to 37% and AFR was about 10%. That's the number we had in Q4.
And this AFR in Q1, can we see will further go up to 13-15%? That's what we were looking at.
FY27, our target is to get this AFR percentage from as a company from 10% to 12-13% is what we will look at. That's the number we are targeting to offset the coal price increase.
And sir, in terms of cost, furthermore, let's assume by the end of this month and election is over, state elections, and if we further can see diesel price going up by 10 odd rupees, which the central government has took a excise rate. So how one can look at this 10 rupees, let's assume 10-11% kind of an increase, will it be a entire 10% will be the direct increase in the freight cost, or will it be a 60-70% and 30-40% is kind of a fixed? That's the way one can look at.
No, I don't think in this investors call I wouldn't be able to give pricing strategy of the company and what are the minute steps, how are we going to manage it. So I basically gave an overview because this is a strategy which we will work, other companies will work. And I would refrain from giving what are all the detailed steps the company will take in the coming 6 to 8 weeks to manage. I gave an overarching picture of reducing petcoke quantity, increasing geo mix, improving our premium share, and moving away from mineral gypsum to FGD. These are the big initiatives we will work on. But to kind of give a mathematical model, if this goes up, this will be the price rise. I don't think I would like to share such kind of information in this call.
Yeah, I got it, sir. But just on a broader perspective, so whatever we have said till now, 8-12 rupees kind of a trade hike and 10-15, so roughly 10-11 rupees kind of at a blended level price hike. And given the obviously the petcoke cost will be, if it stays as it is today, maybe July, August onwards, we will have a hit. And let's assume that, then roughly we are still, and then the 100 rupees packing cost increase is there. So roughly still we are behind in terms of 10 odd rupees on the price hike. 8-10 rupees still
I
further.
don't think I will be answering this question because I cannot do a mathematical reconciliation and say that this much price increase, this much cost increase, suddenly I will not be able to tell. But that won't be, that's not going to be my approach of giving both the details. But all I can share with you is certainly costs have gone up, which I shared with you in a transparent manner, what has been the impact of bags and what has been the impact of fuel in March, and March is all done now. So I guess April, what will be the impact of bags and fuel? I guess certainly the blended cost of fuel, bags, gypsum, rest of all the stuff. I am really looking at a cost inflation of close to 200 rupees per ton. And hence at 200 rupees per ton, with the kind of price increase, net of GST, there is still going to be some gap. But so our effort will be to work on the internal levers, plus I guess an appropriate time when the year has started, I guess quarter ending schemes have ended in the market and then the demand will pick up, summer is coming with elections finishing and all the labor getting back to major markets from the post-election scenario in key states. I think I foresee a demand opening up to 7 to 8% going forward. That's when I plan to catch the pricing trajectory.
Thank you. We'll take our next question from the line of Tejas Pradhan from Citigroup. Please go ahead.
Yeah, hi sir. Just on the balance sheet, if I look at historical trends, 4Q has been typically a quarter when we have unwind in terms of the debt reduction, right? But this quarter, if I look at net debt, it has gone up from 42 billion to 44 billion. And in addition to that, we also had the CCD issue at the Vadraj level, right? So if I adjust for that, then maybe that 3 billion also in addition, the debt would have gone up. So any reason why we had an increase in net debt in the quarter?
Yeah, let me ask Manish, our CFO, to address this query. Manish.
Yeah, so basically if you look at during the quarter, so first of all we had this CCD which has come in, and we use the proceeds to pay off the commercial paper or in terms of the bridge finance that we had taken earlier for the purpose of this Vadraj acquisition. So that is there. Besides that, in terms of, if you look at the overall net debt for the entire year, right? So I'll just give you the whole waterfall for that. So if you look at that, we started the year with a 3,640 crores. And overall net debt, we've ended with a 4,445 crores. So there is a 900 crores increase that has happened. And this is primarily because of the Vadraj acquisition that has happened. So overall investment value for the Vadraj, if you recall in the previous calls, what we have talked about is 1,800 crores. And on top of it, there is this 200 crores that we had funded or made the investment for the VGL acquisition. So altogether, 2,000 crores of investment has been done. And as against that, we have a 900 crores of CCD that has come in. So there is 1100 crores of internal accruals or the borrowing that has gone into funding the entire acquisition. And from the operating cash flows, if you look at around 1880 crores of EBITDA that has been generated, there is an interest of around 450 crores that has gone in. Besides that, the working capital to fund the scale of operations from 19.4 million tons to 20.4 million tons, so there is an increase in the working capital. Besides the capex that has gone in across the plant, the sustaining capex, the normal capex that has gone in for the land mining as well as the capex that has gone for the Vadraj stuff. So that is how the overall 1880 crores of operating cash flows has been utilized. And then there is income tax payment that has gone in this financial year. So altogether, if you look at from the operating cash flows, there is actually a 300 crores of net debt that has reduced, right? But because of this Vadraj acquisition that has happened, so there is a increase that is coming on the balance sheet side to the extent of 900 crores.
Let me just Manish finish it. Manish, thank you for explaining this. We started the year with 3640 crores of net debt. We ended the year with 4445 crores of net debt. This 3640, you have to add close to 200 crores of investments which you have made. It would have gone to 5640. 5640 had 900 crores of CCD. So knock off 900 from 5640. So it will come to 4740. Technically speaking, we had that, we bought something, we did CCD, we should have ended the year with 4740. But we ended the year with 4445. Good 300 crores reduction in debt on a like-to-like comparison coming out of operational efficiency, prudent capex and cash flow generation. So I guess whatever things which I've been talking on every call to kind of find a way to restrict capex, reduce working capital, manage cash flows to do a debt reduction. And all the time we have been talking about when our debt reaches 3,500 to 4,000, we will make the next investment. So that is how we made the next investment. The next investment took the debt up. Now the debt ranges at 44, 45. Technically on mathematical terms, on a like-to-like comparison, it should have been 47, 45. But wonderful work done by the teams brought the number to 44, 45.
So, okay. So just to sort of clarify the question also, just on a quarter-on-quarter basis, if I look at least the last 4 or 5 years, generally 3Q end versus March, there has been like a 4 to 5 billion quarter-on-quarter reduction in net debt. Versus that, this quarter there is a 2 billion increase. So anything specific in this quarter? I understand the full year, so that explanation I understood. Just on a quarter-on-quarter, anything particular to flag off because of which the debt increased?
Our net debt December stood at 4817, and against that 4817 we are at 4445. So there again I think there is a
So the point that you're making is the net debt has gone down slightly higher this time as compared to the previous years?
Okay. So my number was 4,217 crore. I mean, correct me if I'm wrong.
That's not the right number. The number is 4,817.
Okay, understood. So I'll take it offline. No, not an issue.
Yes.
Just on the other data question that I had, was the clinker production in full year FY26 and the lead distance for the fourth quarter? Just these two.
We don't clock clinker production on the company. We report cement production. As regards the lead distance reduction, Q4 to Q3, no substantial reduction in lead distance. We are at 325, just about a kilometer less, 325 km, largely coming due to our, as I explained a little while ago to Satyadeep's question, we had challenges in clinker movement, so we had to kind of do a little bit of trade-off of how can I move clinker to the right places because rake availability was not there everywhere. And second also is the fact that we had to packing bag was also challenged in certain places, and like north factories, it was different, east was different. So we couldn't do too much of impact on the lead distance reduction. It remained at 325.
Sure, thanks. That's all.
Thank you. Next question is from the line of Gaurav Goel from UTI AMC. Please go ahead.
Hi, thank you for the opportunity. Just one quick question. So if you could give the debt and...
Can you speak on the handset, please? You're very, very feeble.
Yeah, am I audible?
Yeah, at this level, you're audible.
Yeah, thank you. So just one quick question. If you could give a guidance on the debt and capex for FY27.
Okay. So on the capex, I would give a guidance. So every quarter we've been talking about capex. So in FY26, the year gone by, I had given an outlook of 700 crores for capex. We ended with 712 crores, a small 10 crore increase. So more or less exactly the same way which we planned for the year. 27 and 28 will be 900 crores for 27 and 960 crores for 28. That's all largely coming out of Vadraj refurbishment, 627 and 728. Overall, next 2 years, 900 crores in FY27, 960 crores in FY28. As regards the debt level number, I guess there is going to be a period of few quarters where this debt is going to be around this number because we have borrowed and invested in Vadraj. However, our goal has been to maintain that debt level to 2 to 2.5 times EBITDA, and there we will meet our numbers during the fiscal FY27.
All right. Thank you so much.
Thank you. Next question is from the line of Girija Ray from Nirmal Bang. Please go ahead.
Hi, thanks for taking my question. One confusion, if I go back to 2022 September, post-COVID, again, there was a spike in pet coke, even though after COVID, the market opens and everything, the infra also started booming. So we were not able, the industry was, struggling to pass on this input cost pressure to the consumers. So even this normal course of situation when, infra is doing well and, the things are getting, in a good phase. So seeing this cost increase, pet coke prices and packaging costs, so how do you see this, the kind of price hike will take, which can be passed on to the, consumers post GST rate cut? Even, if I remember the GST rate cut had given a headroom for 35 to 37 rupees per bag of increase. So far we have increased around 10 to 12 rupees on a blended basis. So, even in September 22, most of the pockets, they have taken a price hike of 50 to 70 rupees. Still, it was not adequate enough to pass on to the consumer. The profitability was impacting that time. So how do you see this can be, what kind of price hike we can take and how this is feasible to pass on to the consumers?
If you look at 4-year window, so I guess I'll little bit jog from my memory and talk about September 22. It's pretty far away, but all I can say is at that time, pet coke was trending nearly close to about $250 per ton, and then the rupees per million cal was also pretty high at that time. It took a good 6 to 8 months for the prices to taper down. But this time around, if you see, pet coke is around trending at 2.04 rupees per million cal. And at this kind of levels, the price hike which we have taken just about meets the cost inflation. So whatever currently we have taken is just about meets the current kind of cost inflation which has happened. So it's kind of a neutral ground as we speak. But any further increase in cost, I guess we will go for additional price increase. I will not be able to comment right now whether it will be 10 rupees per bag or 15 rupees per bag. God forbid the cost doesn't go so much. So So we'll be mindful as a responsible company. But certainly, I think eventually when the overall cost lines go up, I think it will have an impact on the overall economy of the country. So we will go by as the situation unfolds. What is in our control is to tweak the fuel mixture, tweak the model mix, tweak the geo mix, bring about efficiencies, and that's where our immediate focus, the entire team is working on to squeeze out some of the money so that the cost increase can be obviated by the efficiency improvement within the company. Beyond that, we will have to take a price increase. I hope this situation doesn't happen where we have to take big time increases, but I don't rule out any situation where we will not take price increase. I won't say we will take, but certainly I will give her a different way I will answer your question. I'm not ruling out any price increase going forward.
Okay. My last question will be, there is some, kind of decline from past 3 quarters. I can see the employee cost per ton has declined. So that is one. And second one is, related to our capacity utilization. It's very good to see that we have reached a very significant capacity utilization in fourth quarter. So is there anything like we are trying to capture the market or gain the market share, breaking the pricing power? These 2 questions. This will be my last question.
Certainly, I think we will not drop price to increase market share. So I think our focus is profitability. Nuvoco will have to find, as a company, we do a good balancing act between ensuring profitability and also get growth. So we will not kind of buy growth by throwing money. So that's not in the DNA of the organization. We will work very hard to get the profitability right, but certainly I think we'll run behind growth, but certainly not throw money to create growth. That's the DNA of the organization. That is how we have been running our company for last many years, and that's the way we will look at things going forward. As regards to the overall employee benefits per ton, I guess scale also comes to picture. If you see our overall absolute volume growth in FY24 and 25 was 18.8 and 19.4. 2 years we were stuck at 18.8, and another year we went only to 19.4. This was the year where I think the market also improved. We also kind of improved to 20.4. That's where I guess the volume scale benefit also comes to our cost per ton impact.
Thank you, sir. All the best. Thank you, sir.
Thank you. We'll take our next question from the line of Pinakin from HSBC. Please go ahead.
Thank you very much. So my first question is related to demand. So in your view, what was the industry growth in F26? And given in April there has been so much disruption that we are hearing about, how is demand trending in April? Is it flat or has it started declining on a year basis?
So looking at what's the demand this has been, I guess if you really recall our quarter 2, I think we did not have aggressive volume growth, whereas quarter 3 and quarter 4, I guess we did grow. Industry, we are looking at a volume growth in FY26 was 25 anywhere between 6 to 9%. So that's the outlook for the last year. I think that's my read of how the overall market. But again, India is north, south, east, west, central. So various markets have got various growth rates. At an all India level, industry has grown by 6 to 9%. But certain markets like east or even Gujarat for many months during the year or Maharashtra for many months during the year, growth was tepid, less than the national average. But however, as in our opening speech, we mentioned about the infrastructure improvement and the investment government is going to make. I'm still looking positive for this industry to grow anywhere between 7 to 9% in the coming year as well.
Sure, sir. And related to that, how has demand shaped up in April so far, given whatever disruptions we have seen?
Okay. First week anyway, April typically, first week is always a challenging week with the March annual targets for all the dealers across the stuff. But as we speak, I can basically say there are few markets where we don't operate all over India, but certainly in the markets where we operate north, east, and west, and some parts of central, I think there are pockets in India currently where demand is slightly weak. So I'm not going to kind of list on which states their demand is weak. But in our core states of Bihar, Bengal, Jharkhand, Chhattisgarh, there is good demand. And in terms of the first 13-14 days of the month, our pro rata is as per our plan.
Lastly, very quickly, you said
Pinakin, your voice is muffled. Can you repeat your question, please?
Yeah. So for FY27, you mentioned demand growth at industry level of 7 to 9%. So at a Nuvoco level, I mean, it's very early days, but what is the target that you are working with? Because FY26 was 5%. Should we see a pickup in volume sales in F27?
So, you want what I tell my employees, or you want what is likely to happen? So certainly, I think we will certainly want to grow in line with the industry of 7 to 9% for sure in the market. But practically, if you see markets in North, we are kind of operating at 95% capacity utilization. So there, I think once our Gujarat comes in, there is going to be few months in the coming year where we will be short of cement in North. But that's a passing phenomenon. That's part of the stuff. But I have adequate capacity in East. I still have more cement available in East. So we are targeting to grow anywhere between 7 to 9% in line with industry in the coming year as well.
Got it. Thank you very much.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to Mr. Bishnu Sharma for closing comments. Over to you, sir.
Thank you, HSC. Thank you everyone for the question and engagement today. We trust the discussions have been both informative and useful. The IR team remains available for any follow-up clarification you may need after the call. As we close, let me leave you with a few thoughts on where Nuvoco stands and where we are headed. Our growth agenda is firmly on track. The Gujarat cement project is progressing as planned with phased commissioning beginning Q3 FY27, further strengthening our presence across the western and northern markets. Beyond capacity, our strategic priorities remain clear and consistent. Premiumization, geographic optimization, and cost discipline. These are not just aspirations, as they are disciplines we have demonstrated quarter after quarter, and they will continue to drive long-term shareholder value creation. Thank you for your continued support and trust. We look forward to speaking to you again next quarter. Thank you very much.
Thank you. On behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.